Good morning, everyone. Today is April 6th. I'm Jo Ann Koontz, and I'm here with my partner, Marina Parkin. And although we are not awaiting the April 15th tax filing deadline now, because it's been extended this year, Marina is both delighted and devastated about that, I can tell.
True.
Today we wanted to talk to you about Firpta, for those of you who run across that in your daily paths in real estate. Firpta is the Foreign Investment in Real Property Tax Act. If you are in real estate, you might think that you don't run into foreign folks often and might not necessarily need this information, but there's foreign folks everywhere, particularly in our neck of the woods in Sarasota. So it's something helpful, even if you said, I only work with my own family and they just buy property, they still might buy from a foreign seller. So it's important that we get a handle on the Firpta rules. They changed recently. So if you've been in the business for some time and you had some familiarity with these rules, do note that the rules are different now. And it's been a little while, but still we run into folks who are operating under the old, pretenses. So we will kind of be running through sort of what it is, why is it, why do we care, and maybe some more stories, because Marina's always good at that.
That is me.
That is you. So, so without further ado, I will let you take it away, MP.
Sounds good. When we're talking about Firpta, Firpta is one of those things that typically we find out on the day of that Firpta applies, whether Firpta needs to apply or not. So what really is Firpta? Firpta stands for Foreign Investment in Real Property Tax Act. And it's essentially an IRS act that is guiding how the foreigners are treated when they sell real property holdings in US. So there's all sorts of confusion on each and every one of those parts. So essentially, like I said, it seems to be a lot of confusion under each and every one of those words that we have highlighted, as in who is foreign and what is real property, and why is there a tax act about it at all? So I think today we're going to kind of tackle each and every one of those pieces and tell you a little bit about the stories on, boots on the ground kind of stories. But essentially, the idea here is that when you have a foreign person selling real property in US, IRS wants to get their share of that sale. So they don't know if this person is going to sell this property and go back to their home country and they never hear from them again, because that person may or may not have filed tax returns in US and may or may not be a regular filer in general. Mm-hmm. So what they want to do is they want to tax the transaction at the time the transaction takes place. And then once they get their money, the foreigner can go away. So they have imposed this tax, which right now is 15% of the gross selling price that has to be withheld and remitted to IRS no later than 20 days after the date of the closing. So this catches people's attention real quick because everybody's excited to get a contract for sale. These people maybe, have held this property as an investment, or maybe their vacation home. Now they're ready to sell. They want to get their money and they want to leave. Or maybe they're overseas and they haven't been here in years, and that's probably the reason why they're selling. There's also a slew of reasons why the sale takes place, but everybody gets excited real quick the minute they get a contract for sale, and then the wind goes out of their sails also just as quick when they realize that they have to withhold and remit this 15% of the gross sales price to IRS at closing. So what happens with this Firpta is then there's a couple of different situations where we can help those foreign individuals in reducing the amount that they owe to IRS, whether it's at the time of closing or whether we get it back later on tax return. And so I think we wanted to kind of go over some of that decision tree as to what happens. So what happens is when the money, so let's look at the scenario where we take the sales price, we take the 15%, and we remit that to IRS. Oh, well, we're starting with the foreign
Sorry.
person. Yeah, let's, maybe first, since you do have the 10% on there, let's talk a little bit about that. Do you wanna talk about that, Jo Ann, as to when the 10% is kind of an option versus the 15%?
Yes, we have a slide for that, actually.
Okay.
I guess I don't need to skip ahead, but
yeah, you can skip
let me
ahead
first
to that.
say, before we even go there, let me first say that what I run into in the real estate closing world is that sometimes people perceive this as a penalty or additional tax put on a foreign person, and it's really not. It is really just a withholding to ensure that a tax return is later filed. They're not going to pay any more than they would otherwise pay. If the tax due, if there's a capital gain, the tax due is exactly the same. The only difference is this withholding. The IRS is assuming that the seller has no basis or purchase price for the acquisition of the property, so that the whole entire sales price is profit. That's never the case. So there's always a big refund due on these. So what we're really talking about is timing, and timing becomes important, particularly folks from certain countries are very distrustful of the government and don't really believe that the government will return this money. So the opportunity to reduce the withholding from 15% to 10% is sometimes attractive. I have had cases where the realtor has called me and said, well, the seller isn't going to sell if they have to do this. Well, the seller then would need to immigrate and not be foreign for this to not happen. So this is not a penalty for anyone who's foreign. This is really just a procedural safeguard to make sure that the IRS gets paid. How we reduce the withholding from 15% to 10% is in a situation where the buyer, first of all, the purchase price is between $300,000 and $1 million, and the buyer is willing to sign a personal residence, a personal use affidavit. That personal use affidavit seems a bit unrelated to whether or not the seller will actually pay their taxes. It doesn't seem logical that that's what it's based on, but it is. So it's a bit like algebra, like you just have to solve for X, and even though it doesn't make sense, this is what we're doing. Mm-hmm. This is the exercise. And the personal residence, personal use affidavit is really just suggesting that the buyer is going to use the property personally. Them or their family members are going to be using it at least half of the time that it's in use. So vacant time doesn't count. If there's a portion of the time that you'll put it in a rental pool, we just need to make sure that it's rented for as many or less days than you or your family have used the property to be eligible to sign this affidavit. Oftentimes, whether I have the buyer or the seller, there is concern on behalf of the buyer as to signing this affidavit, and they say, well, wait a minute, what if something changes? What if my parents fall ill and I have to spend time up north and I wasn't anticipating? This is really looking at your real plans at the time of closing. So things may change. You can't say, oh, well, I plan to use it, wink, wink, and then you've already in discussions with the rental manager to put it in a rental pool, and then say, oh, I changed my mind and decided to rent it. That kind of evidence would not hold up. But if life happens and circumstances change, the buyer is absolutely showing their cooperation and compliance with Firpta when they sign this affidavit, provided that it's accurate. So sometimes people who are not familiar with Firpta say, I don't really feel comfortable signing this affidavit. Or if it's a lawyer or an accountant who's not familiar with it, they're like, my guy's not signing that, I don't want him to be on the hook. Well, this is one way to show the IRS, like, I'm not on the hook. See, I signed the affidavit. If this guy didn't pay, I still cooperated and participated in the Firpta withholding. So let me forward through here.
Let's tackle the foreign person definition a little bit later. Okay. But I kind of wanted to go through some of that decision on what to do with the withholding and what to do with it later and what our choices are. So I think, yeah, you kind of went over this actually, Jo Ann.
I was full steam ahead. Let me do say that I had mentioned that this is for at least half of the time that the property's in use for each of the first two 12-month periods. You cannot look at the first 2 years. So you can't say, well, I'm going to use it the whole first year and rent it the whole second year. It has to be 50% of the time for each of those two 12-month periods examined separately. And again, vacant time doesn't count. So if there's a period of time where it's not rented and you're not using it, that period of time comes out of the equation. We really went on and on. Is this what
Yeah.
you're looking for? Perfect.
Yeah, I think this is good. This is good.
Okay.
Awesome.
Let me see.
All right, so really, let's talk about our choices and kind of what to do on the withholding and how to possibly get it reduced or how to get the money back.
Okay.
So let's say we determine, as you can see kind of in the first section here, if we do have a sales price that's under 300,000 and we do end up having the buyer sign that affidavit that Jo Ann just talked about, there's 0% that needs to be withheld and remitted to IRS. What does that mean? That means that you do not have to prepare any of the forms. The forms that you commonly hear about, the 8288, A and B, etc., nothing has to be done. Nothing has to be remitted. You do not have to notify IRS about the fact that you comply with it. You just have to have this in your closing documents, affidavit signed, part of the closing file, and that's it. Nothing has to be done. However, this does not absolve the seller of the responsibility to file a tax return at the end of the year and still report to IRS that this transaction happened. Because even if the sales price may have been under 300,000, they may still have had a gain on the sale. So ultimately, they may still have tax due on this transaction, in which case they absolutely have to report. So in what I would do here is, if you're dealing with, let's say you're a realtor, you've got a foreign seller, just advise them that they do need to contact a CPA who's well versed in this area, and make sure they have a copy of this closing statement and have everything ready, and maybe line up a CPA for the following year when spring comes and the non-resident forms become available. So again, nothing to do with closing here, nothing to remit, no correspondence with IRS, but tax return has to be done at the end of the year. Also note that we cannot do a tax return early. So it's not where you can say, well, I sold the property in August, so let me just file my final 2021 tax return in August. Until the 2021 forms come out, which is usually February, March of the following year, you really cannot do it. So it does take a little bit of time, which is why it's probably good to have a CPA or a preparer lined up ahead of time by these foreign sellers, so that they know that when the spring comes, they're gonna be on the list to prepare their tax return. So now let's deal with the two situations, whether it's 10% that we need to remit or whether it's the 15%, depending on whether the that affidavit, personal use affidavit, was signed. So choice number one that we will have is actually to remit the 10 or the 15% at closing. What that means is you have to, the title company who's doing the closing will actually write a check out of your proceeds as the foreign seller and send that amount to IRS 20 days, no later than 20 days after closing. There's a couple of forms that need to accompany this transaction. There's Form 8288 and Form 8288A. Those forms need to be signed and remitted together with the check to IRS. Now, what IRS is going to do here, they're going to take one of those forms, 8288A, they're going to stamp it to indicate that they have received this money. And now they have this withholding on your, i.e. the seller's name and an account, and they're holding it for you. So they got your money. Now, they're going to send that stamped form back to you. And usually it's accompanied by the letter, which essentially says, here you go, seller, we've got your money. Here's the stamp to acknowledge that. Now you can file a tax return, and when you calculate the actual tax due on this transaction, if what we have in our account is more, we will give you a refund. But what they want you to do is they actually want you to attach that stamped form to the tax return. It's really not, it used to be where you actually had to scan that in and attach it, and if you do have that form, it's good. In the last couple of years, I've noticed that either these forms don't come back or these forms don't come back timely. And then the IRS just is, you may not necessarily have it properly applied or whatever the case may be. By the time you get to actually do the tax return, you may not have that 8288A stamp back in your possession. That is not going to stop you from actually filing the tax return. Oftentimes, just having proof that the funds went to IRS is sufficient and should be attached. So I think that if you, let's say if you're a realtor who's helping your foreign seller, I would make sure to ask the title company or the closing attorney for a copy of the correspondence that went to IRS, proving that that money was remitted. I know that when our law firm does the closing, we remit the money to IRS, we always get the certified receipt. And so we always have proof that the money went. And usually if I'm doing a tax return for that foreign seller, if they didn't get their 8288 back stamped, I will get a copy of that certified letter with a certified receipt showing that the money went, and I'll attach that to the tax return. At the very least, you should at least attach the form that did go to IRS to say, hey, this is what was remitted. If you never kept track of certified mail or whatever the case may be. So you just need to, in some way, shape, or form, let IRS know that the withholding and remittance was done at closing, and now when you're doing the tax return, you're simply reminding them that they should have your money in the possession, and then they can apply that. So what happens is when you file the tax return in the spring of the following year, you're actually reporting the sale of this property and calculating the real gain or loss from the sale. So remember, 10% or 15% of the gross proceeds went to IRS. Now you're calculating the gain. What is the gain? The gain is going to be the difference between selling price less original purchase price less all of the closing costs on both sides of the transaction. So if you paid closing costs to get into the property on your closing statement, plus you may have done some renovations and improvements to the property, and in addition, you have paid closing costs to sell the property, like your commissions to the realtor, title fees or fees to some other legal fees. There's a lot of closing costs, like I said, on both sides of the transaction. All of those things do get to reduce the calculation of your gain. So when you're done with calculating your gain and your tax return actually calculates potential tax, you may end up in a situation where you may have a loss, or your tax is going to be minimal, or whatever the case is, the tax is calculated now correctly based on the actual gain. So when you remit that to the IRS, they're going to compare that to the 10% of the gross sales price that they're holding for you, and then they're going to give you the refund back. So that is definitely the one way to get that withholding back. Now, the key here is going to be the timing. So from the date of your closing and the money getting remitted to IRS, depending on when that closing is, you wait till the spring of the following year to file a tax return, plus the processing time that it takes for IRS to actually process the tax return, which in the past used to be about 6 to 8 weeks. Now I think it's a little bit longer. Also, non-residents are a little bit harder to, or it takes a little bit longer for them to process. So it's kind of in the back, goes a little bit in the back burner for IRS. So it has taken quite a while longer. So you may have to sit on waiting on that refund for a while, but like Jo Ann said, it's a timing issue. So ultimately you will get it. There may be some more correspondence back and forth, but you absolutely will receive your refund. So that's one way to get your money back. The other way, which is what a lot of the people hear about, is the withholding certificate. And in fact, when you say the word Firpta, a lot of times it's equivalent in a lot of the real estate agents' mind with the withholding certificate application. So we need Firpta. Well, Firpta can mean you just need to remit money to IRS, not necessarily ask them not to remit it. So what is this withholding certificate thing? So the withholding certificate is essentially an early tax return. It goes on a different form. It's Form 8288B, and it goes through the calculation of the gain or loss from the sale of the property to show IRS that you in fact do not need to pay as much tax as 10 or 15% of the closing prices. And you go through this big fancy calculation, and there's, you know, specific format that it has to be attached in. And once you show that there should be no gain, let's say in a situation where you have a loss, you submit that to IRS, and then IRS will then process it and then tell you, yes, we agree, or no, we do not agree. Now, what happens in the meantime? So this withholding certificate has to be remitted to IRS no later than the actual date of the closing. If you submitted it the next day, it's late, and then IRS is gonna email, or man, please don't, IRS will never email. IRS is going to mail you a notice to say, no, the withholding certificate cannot be processed. It was late, please remit the money.
Mm-hmm.
So it has to be done no later than the date of the closing. In the meantime, the title company or the attorney who's doing your closing has to still withhold the money. Because if IRS says that we do not approve your application for a withholding certificate, or we don't agree with the numbers, or maybe you used something wrong, or did something wrong, or you used the wrong amounts, then IRS will again mail a letter to say, for whatever reason, I mean, they don't need a whole lot of reason. If something is not done to the T, they will deny the withholding certificate application. So then the money is already sitting in escrow with the closing agent, and then can then be remitted to IRS when the letter is received. So the idea here is you're still not getting out of the withholding at the immediate date of the closing. And that's really important for a lot of the agents to understand, is that your seller is not, just because we're filing the application for withholding certificate, the money is still going to sit in the escrow account until that withholding certificate is reviewed and approved. The good news is that it's sitting in the escrow account. It's not sitting in the IRS account. So the minute the IRS approves that withholding certificate application, the money can get wired to your seller, wherever they are, very, very quickly. If IRS, for some reason, denies the withholding certificate application, then that money goes into IRS, and you're back to kind of scenario number one, where now you get to file a tax return and get that money back at that time. So there's a lot of that timing. Everything here is very, very time sensitive. So the minute that you get any of the correspondence from IRS, you have to know, for example, if IRS denies the withholding certificate application, when they send you that letter, the funds do need to be remitted to them within 20 days of that letter. If the funds are late, the interest and penalties are ridiculous. In fact, we had one situation not too long ago where the money was remitted timely, but for some reason IRS didn't stamp it daily or on the right day, or whatever the case is, and they just started bombarding the individuals with the late penalties, and we just had to keep sending them proof that the money was remitted on time. But you know, and then here's these foreigners getting threat mail from IRS to, oh my God, here's, you know, thousands and thousands of dollars of penalties for not remitting this right. So it's oftentimes a big mess. So being in correspondence with your CPA who helped you with this, or your attorney who helped you with this, is key. And if you do get any mail from IRS, for whatever correspondence relating to Firpta, immediately you have to forward that on. Oftentimes, if we know that the seller is foreign and their mailing address is a little, you know, they may get their mail slow, or just in last year with COVID, the mail was all over the place. We oftentimes put our office address as the correspondence for anything to do with the withholding certificate, and we can do that. This way we get a letter from IRS saying that it was approved or it was denied, please send us money, or congratulations, whatever the case may be. We get on that quickly so that we don't miss any of those important time windows. So with this withholding certificate application, what makes it challenging to do it, so it seems like it's a great idea because, you know, if IRS is going to approve this within a couple of months, then why should I wait till the next year to tax return filing to get my money back if I can just have my money sit in escrow, wait for the approval, and get my money back that way? So there's a couple of reasons why you may not want to do the withholding certificate application. So generally speaking, IRS has taken, in good times, about 60 to 90 days to approve the withholding certificate application. However, in the times of COVID, they have been taken, I would say right now it's a little bit better, it's about 6 months. Last year, we did a few early in the year. They were 8, 9, 10 months. We did a couple of Firptas in March, and they just got approved in like January, February of this year. And so you may be better off waiting to actually file your tax return to ask for a refund than waiting for the withholding certificate to be approved. So that's one of the reasons why you may want to wait. Depending on the timing of your sale as well. So if your sale is earlier in the year, withholding certificate application may be a better option, because let's just say we're back to normal times. We got processing time 3 to 4 months. Your sale is in the first part of the year. Say your sale is right now in April. By, hopefully July, August, September, you're going to get the withholding certificate approved. You get your money back that way. Otherwise, you wait till next year spring to get that money back. If this timing of the sale is in a second part of the year, then you're pushed up against the tax filing deadline anyway. So in that case, you might as well save the time, send the money to IRS, and then in a few months' time, you're turning around and doing the tax return and ask for the money back. So I think that typically we've advised people, if you're closing somewhere around like past August, so basically in the last quarter of the year, don't worry about the withholding certificate application. Send the money into IRS, wait a few more months, let's file a tax return and get your money back. So we're looking at the timing. The other thing we look at is actually the documentation that needs to be submitted. So let's say it's a situation where part of the cost of purchasing or building the property is in invoices on improvements. So usually when you file a tax return to show the gain or loss from the sale of the property, you do not need to submit any backup documentation. If IRS is auditing your return, they will ask for the backup. So they will ask for the closing statements, they will ask for the receipts for the improvements. So you still need to have all of that stuff. However, you do not need to submit it to IRS at the time of tax return. So if they're in the box and if they're kind of in, not photocopied and kind of a weird shape, you don't have to pull all of that properly together when you file a tax return. However, for a withholding certificate application, you do. So when we submit it, like I said, it's kind of a mini tax return, except the documentation has to be attached. We just did a Firpta just last week, in fact, for the withholding certificate application, and there was about 60 pages of improvements. We had to go through the receipts, and we had to go through the receipts. And first, we had to make sure that those were considered improvements. So a lot of them were just repairs and maintenance, which IRS does not take to add to the cost basis of the property. But a lot of them were proper improvements. There was a lot of stuff done, major stuff done to the house, but we needed to go through the receipts and make sure they were in good shape, make sure that they were legible, and make sure that they had proper description, so that when IRS would review the calculation of our gain, they would accept all of them. So it takes a lot more time if you've got the backup documentation to pull all of that together. So that's the other reason sometimes when people say, oh, I'm in England and my receipts are in my rental property here, and now it's moved to my friend's house and they're in the box and I don't have them. If there's really no ability to pull that together, we say, forget about the withholding certificate application, just wait and let's just do a tax return. So that's kind of the other reason why that sometimes happens. And
or they might still want to do the withholding certificate application, just not add the improvements. So it's still less money that you're waiting on. It's not all or nothing. You know, it just kind of,
Exactly.
everyone has a different appetite for that thing.
That's absolutely right. And I think this is a great point, Jo Ann, because it kind of goes to show what is, that every situation is going to be different. And what people's appetite, like you say, whether I absolutely hate to have my money sitting with IRS, so I am going to file a withholding certificate application to at least try to minimize my tax, and I'd rather have my money sit in the K&A escrow account, and then get some of it back and the rest of it back at tax return time. So every situation is very much unique. And that's why there's no kind of, oh yeah, you should just do that. You need to talk to an attorney or CPA about what all those choices are. You know, the timing of your sale, the amount of your sale, the anticipated gain or loss, what is going to be better. Plus, of course, the situation that you're in. If you're doing the withholding certificate application, aside from COVID time, if you're doing it in the middle of tax season, IRS is going to take longer to process it anyway, because that's just not their priority. If you're doing it in the off season, you're likely going to get it processed faster. So that's the other thing that can kind of throw a wrench in the equation. Finally, what I wanted to kind of discuss as another potential wrench as to why we may or may not want to do the withholding certificate application is the ITIN. That's kind of a separate beast altogether. And the ITIN is the taxpayer identification number, which is assigned to a foreign person doing any tax filings or transactions in US. Unfortunately, if you have if you're doing the withholding certificate, or even if you're just remitting money and planning to do a tax return, as the foreign seller, you need to have a tax ID number. If you don't have a tax ID number, or maybe you had one before, but now it's expired because you hadn't filed in years in US, you need to get one as part of the process of doing this withholding. Depending on where you are, if you're here, if you're overseas, if you can get if you're able to get that number, that may or may not make it possible for you to do the withholding certificate application. So if the seller or the buyer, for that matter, the buyer can also be foreign, if either one of those parties do not have a tax ID number, you can still do a withholding certificate application, but it needs to go together with the ITIN number. It cannot go separately. It's got to go together. A lot of times that's not possible. You may be overseas. You may not have the certified acceptance agent available where you are to certify a copy of your passport, because that's the ITIN is a whole separate process. And I think we even had a whole separate webinar about what is ITIN and how to get it. If you cannot get an ITIN number, or cannot get an application for an ITIN number that can go together with a withholding certificate, you don't do withholding certificate, period. You may have all your receipts, all the ducks in a row, all your closing statement, all the backup documentation ready. If you cannot get the ITIN application together at the same time, don't do withholding certificate. It's going to get denied, I can guarantee you. And that goes together for the buyer and the seller information. This is all coming from experience. So what do you do then? In that case, you're kind of forced to remit money to IRS. So the money that can go at closing to IRS, whether or not you have an ITIN. So then you have a little bit more time. What happens is when you remit the money to IRS at closing, when you go to prepare the tax return next year, you can then submit the tax return together with the ITIN application at that time. So if you can get yourself together for the ITIN app now, you can do it by the time you're filing your tax return. You can do it even a little bit earlier, because now you've got the withholding that's sitting with IRS, so you've got a reason to get your ITIN, but you can definitely do it by the time the tax return is filed. And that may again be the reason why we don't do the withholding certificate application, but instead wait till the end of the year to to file the tax return. So again, very important to remember. I also cannot stress enough, if you are, let's say, an agent who's assisting the seller and knows that the seller is foreign, and start ringing bells about, do we need withholding certificate or money or remittance or 10%, 15%, to pay attention to who your buyer is. The buyer may have a last name that is American name, but they may be Canadian, so they're foreign, so they don't have an ITIN either, which throws, you've just paid, you know, $3,000 to have all this fancy withholding certificate done, and we can't do it because the buyer, who's foreign, unless they have a tax ID number for some other reason, don't have a reason to get the tax ID number now when they're buying property at all. So you're now in a situation where we've done all of this, we didn't realize it. So all of those kind of boxes need to be ticked to make sure that you're doing the right thing as far as this withholding is concerned, and keep communicating with the attorney who's doing the closing, with the CPA who's helping you with this. It's very important. So these are all the factors that when people call us and say, hey, I have a, you know, what do I do? We go through this whole song and dance
Every time.
based on the particular situation to say, let's gather all the facts. Based on all the facts that we've gathered, what should we do? And then we give your advice.
Let me jump in there real quick with timing before you run off. The one thing I will say, particularly for the realtors in the group, is if we know that someone is foreign and Firpta may apply, when you take that listing is a great time to connect us, because at that point, if there are improvements that have been made, it gives that foreign seller time to accumulate that documentation before there's even an offer. We can't submit this Firpta application to the IRS until there is a written contract from a buyer. But as soon as we get that contract, we could submit. So like Marina said, it might take 6 months. Your property might be under contract for 30 or 45 days. So there's a month or a month and a half of your 6 months that you'd be waiting for the money anyways, because the closing hasn't happened. So if we're prepared and we're not finding out about this a week or 5 days before closing, instead we're finding out about it before it's even under contract, then our paperwork is ready to go. All we're waiting on is the contract to be fully executed and a draft closing statement from the closing agent. Boom, we submit to IRS, and now both clocks are ticking at the same time, substantially reducing the amount of time that the seller has to wait for the money, and more importantly, reducing the stress that is involved, because when they are negotiating the contract and getting, you know, the final details sorted out and fussing about inspections and appraisals and all of those other things that come once you're under contract, that's not when people really want to sit down and start ticking and tying paperwork. So if we can get that out of the way ahead of time, it makes for a much more seamless transaction for all of the parties. It's a lot less stressful, and it just goes a lot more smoothly, and then people have their money back sooner, which makes everybody happy. So
yeah, absolutely. This is not an easy thing at all, and it's not one, you know, one shoe fits everybody. Jo Ann, I wanted you to talk a little bit about the foreign person. What is the foreign person? I know that's also quite a thing that comes up, and there's a lot of situations, but if you can maybe talk a little bit about that.
So the foreign person situation sounds kind of silly. People think, oh, well, you know, how would you know, or why does it matter? Really what we have to be cognizant of is who we're dealing with and why, particularly when it comes to companies. So a lot of times people say, well, you know, you have to first have that conversation, because people will say, well, I have an H-2 visa or I have a green card. Keep in mind that this tax residency status is completely separate from your immigration status. So while typically green card holders are not subject to Firpta, that's not an automatic. The other thing that I'll hear people say, particularly realtors, when I'm asking about Firpta, is they'll say, well, he has a social security number, or he already has an ITIN. So that also doesn't necessarily indicate that you are or are not a tax resident for U.S. income tax purposes. The other danger with already having an ITIN for someone who knows already that they're foreign is that those expire now. So if you've left it lying around and you haven't had a reason to file a U.S. tax return, that ITIN may no longer be valid. Again, if we're having this conversation when the listing is taken before there's even a buyer, there's time to sort through those things in a much more casual fashion than what there is when there's some urgency, because there is a because there is a contract. The key question for anyone to ask a seller, whether it's a title agent or a realtor, is what type of tax return they file in the US. Ask, are you filing a 1040 or are you filing a 1040 NR? The reason I would suggest that you do this leading part of the question is, I once just flatly asked the question in email and said, what type of tax return are you filing in US? And the client responded, the normal one. That right there tells me they're foreign because they don't appreciate, you know, if you ask an American who's been here their whole life, they know 1040 is like, it's something you rattle off the top of your head. So the fact that someone has some lack of familiarity is also an indicator that that might be someone who is foreign.
Absolutely. And the green card is also a big thing that I kind of want to mention here, because a lot of the countries, you know, depending on the treaty, so you may have an individual who has a green card, but they still have are able to take a treaty exemption and still be considered a non-resident of the US. So just because with the green card, there can still be filing a 1040 NR, the non-resident return, which makes them still subject to the Firpta rules, even with the green card. And then same thing goes for the E2 visa, particularly because the people under E2 visa get social security numbers. It's the same thing. I don't have an ITIN, I have a regular social security number. Yes, but if you're in the E2 visa and you again have elected to file as a non-resident, because the E2 visa is a non-immigrant visa where depending on what you do, you may still have an election of how you file. So let's say most of the E2 people are here and they start filing as residents, but a lot of them, especially it could be the first year that you're crossing over and you're still filing as a non-resident. You've got Social Security, but you're filing as a non-resident. So you're subject to Firpta rules. This is where all of this kind of fact gathering comes into play. In fact, we had one situation where it was exactly that. We had a couple who were on the E2 visa, they bought a business, they had a rental property here prior. When they got the E2 visa and moved here for the business, they were selling this rental property because now they wanted to buy a normal family home or whatnot. So when they were selling their rental property, they were subject to Firpta rules because they were still non-residents at that time. A couple of years later, they became U.S. tax residents, but it just the timing fell where it did apply to you. So it's you know, it's very kind of situational based. So that's the other thing that I wanted to mention too on the foreign person is if there's a company. That often is a big area of confusion. If you are a foreign individual and you have formed an LLC in US to hold your, say, rental or investment property, if you are the only owner of that LLC for tax purposes is considered a disregarded entity, meaning you as the individual are still subject to Firpta rules. Even though the LLC, which is a domestically formed entity, owns the property, because it's considered disregarded for tax as you're the only owner, now Firpta applies. So that is extremely important. On the other hand, if you've got a domestic LLC and you've got more than one owner, both of them, they can be some foreign, some non-foreign, both of them, 2, 3 partners foreign. Firpta does not apply at the time of the sale. Firpta applies at a different time when that partnership files a tax return, but there is no Firpta at the time of sale. So that's also important to remember. If anytime we hear foreign person and we hear an LLC, before we go through the whole explanation of 15-10%, we first look at what kind of LLC it is. If it is a partnership, then we don't have to worry about withholding at the time of sale. Foreign person is also foreign corporation. So if you've got a foreign corporation that owns a property here in US, it's the same thing. They have to file, remit money to IRS, file a tax return to get that back. And I had a situation last year where it was a foreign corporation. We actually do their tax returns, and they were selling one of their investment properties. And I guess the attorney that they went to, or a title company, just, you know, it was the name of their name of the company, and they're in Inc. So nothing alerted that attorney that they were foreign corp. The no Firpta, they did not do Firpta at the time of closing. So when they came to me with a closing statement at tax time to say, hey, okay, we've sold our rental and, you know, now we have to show it on the tax return. And they said, oh, we can get you withholding back. And they said, what withholding? So I rolled my eyes out loud. So here's
the kicker to that. If you're the realtor, that fine, the title company missed it, but ultimately the letter of the law under section 1445 of the Internal Revenue Code says it's the buyer's responsibility. So if that client of yours that's otherwise a good tax-paying client wasn't honest and didn't file, the buyer would be responsible for the tax in that circumstance. So it doesn't say the title company, it says the buyer. Now, can the buyer go back against the title company? Probably. But ultimately, the IRS is knocking at your door as the buyer. If you're the realtor and you say, I don't deal with foreign, I don't need to know this, this is exactly where things like this can happen. If you see that closing statement and you say, hey, why is there not withholding? You know, you can really earn your keep there because you know, people are human and things do slip through the cracks, and a lot of people are confused about the corporate ownership, but it's definitely nothing. We're not trying to make everybody an expert. We're trying to put everybody on alert so that you can have your eyes open for these issues, because they come up with some frequency, particularly in our area, between the location, the desirability, the weather, IMG, the fact that people are looking to invest in the US to get their money out of their home country. We do have quite a bit of foreign investment here. So it happens probably more here than in lots of other places in the country. So definitely something to be mindful of.
Absolutely. That is just, all of this was kind of to, you know, not necessarily to scare you, but just to let you know how quickly this can go sideways. And, you know, if you're not looking at these kinds of things early on in the process, it can escalate real bad. Because usually what ends up happening is we're out of time to be able to do anything or plan. And, you know, you get to the closing table and boom, 15% goes to IRS.
Yeah. And here's the other problem, especially if you're the realtor or if you're the foreign seller and you need that money to go buy something else. You were planning, you know, because 15% adds up quick. You know, this can be $85,000, $105,000, $150,000 real fast with the sales prices we see in our market. If you need that money to complete the next sale and the IRS is holding on to it for a year, you got a problem. If you're due to close in 30 days on something you're not going to have your sales proceeds for, that can be problematic. So this definitely can be part of a chain reaction that's not spectacular if you aren't careful with your planning. So perfect.
I think we've scared people enough.
Yeah, you scared me.
I'm scared myself.
And for the Russian judge. So
that's right. That's exactly right.
So thank you, Marina, for that recap. Folks, if you have questions about this or any other topic, you're always welcome to email us offline. These recordings are provided for you to rewatch in case you weren't scared enough. And you can find them on our YouTube channel, on our Koontz Associates and Koontz Parkin Facebook pages, and they'll be distributed if you're lucky enough to be on the email list. Join us next week if this wasn't scary enough. We're going to be talking about the importance of title insurance. So we'll be back with a big bag of disasters that do occur, and why title insurance is important, what it means, what to look for, and any other questions that you have there. So have a great week. I hope you're recovering from your holiday hangover, and if you need anything, let us know. We'll see you next Tuesday.
Thank you.
Thanks. Bye.